All right, let's talk about the Fed. They've just made a huge move, a liquidity pivot that's going to completely change the game for investors all the way through 2026. So let's jump right in and break it down. Okay, so let's be real. The money printer is officially warming up again. Now, it's not going full brrr just yet, but the Fed is definitely turning that dial. The message here is crystal clear. That whole era of aggressively tightening the money supply, yeah, that's over. But what does this actually mean for your money? I mean, that's the real question, right? We're going to dig into how this ripples out and affects everything. Your stocks, the housing market, and yeah, even things like gold and Bitcoin. So the Fed basically did two massive things. First, they cut interest rates. But honestly, the bigger story, the more fundamental shift, is what they've decided to do with something called quantitative tightening. You'll hear it called QT. So what is QT? Put simply, it's just the Fed pulling cash out of the financial system. Think of it like a vacuum cleaner for money. And for the last couple of years, this has been a constant drag, a real headwind for the markets. Okay, let me put it this way. Under QT, the Fed was basically a giant sponge, just soaking up all the extra money. Now, they've taken that sponge out of the bucket. We've gone from a policy that was actively shrinking the money supply to one that's just, stabilizing it. The key thing to get here is that they've stopped the drain. So you gotta ask, why the sudden change of heart? What's behind this pivot? It really boils down to two big things. A job market that's starting to look a little shaky and a serious lack of good data. You know, the Fed really has two main jobs: keep prices from going crazy and make sure people have jobs. Right now, that balance is tilting, big time, towards protecting employment. We're seeing job gains slow down, small businesses are pulling back on hiring, so the Fed is stepping in now, trying to get ahead of a bigger problem. And get this, Fed Chair Jerome Powell pretty much admitted how tough it's been. He used this great analogy. It's like slowing down when driving through fog. See, a recent government shutdown caused what they call a data blackout. So they were forced to make these huge policy decisions while basically flying blind, working with patchy, incomplete information. No easy task. And of course, you can't ignore the politics of it all. Powell's term is up in May 2026, and you better believe there's pressure to keep the economy humming along. That's always in the background, and it could definitely play a role in how fast and how far they go with these changes. Okay, so all this pressure, whether it's from politics or just bad data, has huge implications. Let's talk about the stock market. What does all this new liquidity mean for equities? Well, we're at a serious crossroads. On one hand, you've got some incredibly bullish history on your side, but on the other, there are some very real hidden risks lurking. Let's start with the good news, the bull case. And wow, history is screamingly positive here. Get this, when the Fed cuts rates while the market is already near an all-time high, the S&P 500 has ended up positive over the next 12 months, 93% of the time. That's a huge number.
And we're not talking about tiny gains either. The average gain in those periods was a solid 13%. And if you strip out the times when a recession hit, that number jumps to an even more impressive 18%. So the historical case is strong.
But, and this is a huge but, here's the catch. That amazing historical trend comes with a ton of volatility. The same exact data shows that even in those good years, you could see these violent, gut-wrenching drops of 15, even 20% along the way. So it's not a smooth ride up. And this split, this tension, is perfectly reflected in what the experts are saying. It's really a tale of two outlooks. You've got big players like Morgan Stanley and Bank of America, who are pretty optimistic, looking for more gains into 2026, pointing to strong earnings and AI. But then you have Goldman Sachs on the other side, basically saying, hold on, valuations are sky high, there's too much risk in just a few big tech stocks. We're looking at maybe 3% a year for the next decade. A huge difference in opinion. And what's throwing gasoline on this volatility fire? Well, there's been a huge surge in these super speculative products like leveraged ETFs. These things basically use borrowed money to try and get like 5 times the daily return. But that also means 5 times the loss. It basically juices up the entire market with debt, which means any little dip could get magnified and turn into a huge drop fast. Okay, so that's the stock market. But let's zoom out, because this liquidity pivot is sending massive ripples everywhere. Let's talk about what this means for housing and for those scarce assets like gold and Bitcoin. First up, housing. This could be the thing that finally breaks the ice. People are talking about a transactional thaw. The idea is, with mortgage rates expected to finally dip below 6%, we could see a 10% jump in home sales. All those people who felt locked in by their super low rates might finally feel like they can afford to move. But here's the thing. More people moving doesn't fix the root problem, which is the massive affordability crisis we're in. Right now, it takes a staggering 47%, almost half, of a typical person's income just to afford a median-priced home. To put that in perspective, that's worse than it was at the absolute peak right before the 2008 crash. So what you get is this deeply divided, kind of a two-tiered market. It's a tale of haves and have-nots. On one side, you have all cash purchases hitting all-time highs. But on the other, first-time buyers are just getting crushed. Their share of the market has fallen to a record low. The typical age of a first-time buyer is now 40. It's just an incredibly tough world out there unless you're rolling in cash. And that brings us to gold and Bitcoin. Think about it. For assets that have a limited or even a fixed supply, the Fed turning the liquidity taps back on is a huge tailwind. Why? Because when more dollars are being created, each dollar is potentially worth a little less. So things that are scarce, that you can't just print more of, become way more valuable. They're seen as a hedge against that currency dilution. Okay, so we've got all these conflicting signals, all these complex cross-currents. The big question is, how do you actually navigate all this over the next couple of years? Let's put together a clear strategic blueprint. Look, in an environment like this, a solid strategy really comes down to 4 key pillars. Number 1, keep some cash on the sidelines. That's your dry powder to jump on opportunities when that volatility hits. 2, it's time to rethink your bonds. 3, for stocks, the name of the game is discipline. And 4, don't forget to hedge against that long-term risk of a weaker dollar. Let's dive a little deeper on that second pillar, rethinking your bonds, specifically extending your duration. See, as the Fed cuts rates, the interest you get on short-term bonds is going to drop. So the smart move could be to lock in today's higher rates on longer-term bonds, especially tax-free municipal bonds. Just look at the numbers. For someone in a high tax bracket, getting 4.3% on a tax-free muni is the same as getting almost 7% on a regular taxable bond. That's a huge advantage. And that really brings us to the big final question. We're heading into an era of, let's call it engineered liquidity. The Fed has made it clear they're back in the game, and the temptation for everyone is going to be to chase those quick speculative wins. But in a world with so much volatility and sky-high valuations, maybe the real way to win, the real alpha, isn't about being flashy. Maybe, just maybe, it's about something a lot more boring, but a lot more powerful. Disciplined patience.